Hey guys, welcome back to the podcast. JC Peretz here. Boy, do I have a special guest for you today. John Roque is one of my all-time favorite technicians. He loves charts, he loves sports, and he loves good people. What's better than that? In this conversation, we talk about the stock market, obviously, but we also talk about gold prices, Bitcoin, and we dive into tech stocks. John also shares some fun stories about those who inspired him throughout his career, people like Sam Weinstein and Jeff Weiss. And he also shares some of the things that he's learned more recently. This was a ton of fun and a real treat for me. So without further ado, here's my conversation with John Roque.
Hey, JC, thanks for the offer. Good to see you.
Yeah, likewise.
Thanks a lot.
This is great. I love talking about markets with you. Patrick hit me up the other day. He's like, "Oh, I was hanging out with Roque," and I was like, "I want to hang out with Roque."
That's funny. Thanks. Yeah, we had a good lunch. We had a good few laughs. It was good.
He knows a lot of tech. He knows probably more technicians than most technicians in this world. He knows a lot of them.
True. I bet that's true. I said, hey, he mentioned Stan Weinstein. I said, I know Stan Weinstein. He said, you know Stan Weinstein. It was one of those kind of things.
So tell me about Stan Weinstein. I mean, we're recording, so we could just flow and just chit chat. I don't really have an agenda. I just want to catch up with you, talk markets, and I have a funny feeling the rest of the world will want to listen in. So talk to me about Stan Weinstein. I've never met him.
Stan Weinstein's a great guy. So many years ago, when I was at Arnhold and S. Bleischroeder, I had a client who subscribed to Stan's service. I said, Andrew, I'd really like to meet Stan. I said, where does he live? He said, he lives in Florida. I said, well, I have a marketing trip coming up, then I'm going to see Templeton in Florida. Where's he live? And so he told me, and it was fairly close at that time to where Templeton was. And so Stan was kind enough. He gave me his phone number. He gave me his address. He invited me into his home. We talked a lot about markets. He gave me a copy of his book, which I still have to this day. He inscribed it. I took a picture of it not so long ago, and I sent it to him because we got reintroduced after a number of years, and we're in contact fairly frequently. He's a great guy, great market savant, great feel. Just, and has stuck to his game plan the whole time. And, you mentioned to me some days ago, you said, John, I hope you have a sports analogy. And so I think Stan Weinstein, I think he's like Mariano Rivera. Mariano Rivera is in the Hall of Fame, and he essentially threw one pitch his entire career. Nobody said to Mariano, you got to work in a knuckleball. Nobody said to him, you got to work in a changeup. He threw a cut fastball better than just about anybody did. He broke a lot of bats, saved a lot of games, and is in the Hall of Fame. So I guess the analogy here is that Stan's done one thing and one thing very well his entire career. He's in the Hall of Fame for technicians, and Mariano Rivera has done one thing and one thing very well, and he's in the Baseball Hall of Fame. So that's my analogy.
I'm curious. I love that, by the way, and I want more out of you. But before we continue on that, I mean, from what I know about Stan Weinstein, he's good at a lot of things. I mean, obviously, market. Is there something specific in terms of his strategy that you're alluding to?
He has a system. His system is, he takes you through kind of the various life cycle of a stock, 1A, 1B, et cetera. And it kind of looks like, if you're old enough like me to remember, Marlo Thomas's hairdo from That Girl. It kind of was a distribution curve. That's what her hairdo looked like in That Girl. She's the daughter of Danny Thomas, but that goes way back.
I was going to say, John, I don't know what you're talking about. I'm pretty. There's definitely people who do know what you're talking about, and they're probably laughing. For me, that one's over my head.
Dan had I used to use the Marlo Thomas hairdo to kind of describe, the life cycle of a stock. It starts out slow, has a big base, breaks out, accelerates. And then when it gets to the top and distributes, the news gets better, but the stock doesn't get any better because the people with superior fundamental information are selling to people with inferior fundamental information. And then you go through a kind of a topping phase, and the right side of the chart is the opposite of what the left side was. That's essentially kind of, I think, Stan's system. He kind of labels them 1A, 2A, et cetera. And it just looks to me like a distribution curve, which I've always thought looked like Marlo Thomas's hairdo. So if you're old enough to remember, if you know, you know.
If you know, you know. Who else was a big inspiration to you, John?
There's nobody better in my book. There are a lot of great guys that I've met through my career, but Steve Chauvin was the best of them all. I'm still in contact with him today. The greatest quipster of all time. He's the original big bass guy. So Steve, thank you for that. a tremendous sports fan, a tremendous storyteller, raconteur, just wonderful, wonderful, self-deprecating humor, but a terrific technician, terrific. And he introduced me to big bases, and I converted it to Brobdingnagian bases. And I just want to say thanks. He was very, very instrumental to me. A wonderful, wonderful person as well.
Today we call them Kardashian bottoms.
I don't know if I could say that in an institutional forum.
I have. I think they appreciate that sort of thing. It's all good. Who else inspired you or, was an inspiration to you early on?
I met Jeff Weiss, who was formerly at Shearson Lehman, and then he went to Payne Weber. Jeff Weiss was very helpful to me as well. He invited me into his office when he didn't know me. This was when you could go into buildings and you just, without having an ID card or to be screened. I mean, he invited me in, and I would go see him every few months, and he was just instrumental. He helped point me toward, books that he thought I should have been reading, Reminiscences of a Stock Operator, for example, Devil Take the Hindmost, all those wonderful books about our business. And so Jeff, probably unwittingly, but he also was very helpful to me, and amongst the kinder guys you'll ever meet anywhere in any business.
Yep. I know Jeff Weiss. He's been on the podcast. We've had lunch and chat often. Shout out Jeff Weiss. He after a lunch with him, you walk out of there fired up, right?
He is among the kinder guys you're ever going to meet, and just so disarming, but with a lifetime worth of technical knowledge and great recall. Steve Shobin, also great recall. I think guys that have just been so passionate about the markets are able to tell you about prior cycles and kind of either relate the current cycle or dismiss the current cycle relative to prior cycles. So I think those guys are just priceless.
What's interesting about the markets is that it forces you to be a historian, because especially, like as chart guys like us, like we can go to the chart, be like, I know where I was, I know who I was with, right. What we were arguing about at the time, it takes you back.
Yeah, it's right. It is a picture of your own history along with the chart's own history. And I'm fond of a line that was said by Michael Crichton, who was the great science fiction writer. He said, if you don't know your history, it's like a leaf that doesn't know it's a part of a tree. So I think it's incumbent upon us as market people to kind of understand the history that we're looking at, or what the period meant, at least vis-a-vis the chart, the economy, the environment, and what it should mean to us now. So I agree with you.
John, early in my career, when I was first becoming a technician, you were definitely one of the guys that stood out. One of the people in general. Luis Yamato was another one, Alan Shaw, Ralph Acampora, John Murphy, but you're definitely in that group as far as I'm concerned. I'm a Roque disciple. I catch myself saying certain things that I forgot that I learned from you, and then I hear you saying it. I was like, that's where that came from.
Thanks a lot.
One thing that we're not in a reversion to the mean business. We're in a reversion beyond the mean. That's a Roqueism.
Yeah, that is. Thanks a lot. Yeah, I use that because I think most people don't think of the business like that. It never stops at the mean, right? Never. On the back of your baseball card, your lifetime average is 324, and you play 10 years in the majors. I don't know if once you even hit 324, but your average is 324, right?
That's exactly right. When you talk about how the S&P 500 averages 8% a year, how many times has it actually returned 8% in a year?
Yeah, you're right. There you go.
Another thing that I always admired about you, the work that you do with sector market cap as a percentage of overall market cap, how you, and then take that one step further, and then just how you manipulate the sectors to bring them together. You want to talk about sort of how that evolved from when you first started looking at sector market cap to then adding some together and creating your own market cap?
Another guy who I should mention as being instrumental is a guy named Robert Rossetti, who was at Morgan Stanley at the time. Bob was a technical guy at heart, although certainly a fundamental guy as well. I kind of put together some data on historical market caps for the sectors in the S&P, and Bob helped me out to a great degree, and he just gave me data that went back even further in time. So I was always very thankful for him to do that. It was helpful to me in the 2000 period to identify just how big tech had grown relative to the rest of the market. And then when the S&P made changes, I believe it was in 2018, And they told us that tech is now smaller than it should have been, just because we're in the market and we know it shouldn't be this small. They removed some items from tech proper and they put it into what they call the communication services group. And so I said to myself, this doesn't make any sense at all. There's no way that tech right now, as we speak, is 28.5% of the S&P. So I took all the items that they took out of tech and I put it back into tech. And I took some of the ones from consumer discretionary that I didn't think should be there because they're tech, and I put that back to tech. And tech's relative market cap weight as a percent of the S&P, September of 2020, was 44% of the S&P. So that's really the number. And if you just think about it, I mean, 7 stocks in the S&P 500 are just 7 stocks are 24% of the index, and they're 40% of NASDAQ. So how can the S&P be only 28.5% of tech weighting, 28.5% attributed to tech if 7 stocks are that weighting by themselves? So I think the S&Ps played a little game because they moved stuff around. I'm not saying that they did it surreptitiously, but I just don't think it presents the underlying constituents in the right manner. And I think by readjusting it puts us back in the right manner. They did the same thing with financials and REITs.
Right.
They took REITs out of the financials, and now when you add the REITs and the financials back, you get about 13.6%, but financials by themselves are 11. But when you put them back where they should have been, they're 13.6 and bigger than discretionary. So I've tried to do that to present some sort of continuity.
And on that, you mentioned that the market cap as a percentage of total market cap for technology, including communications, peaked in September of 2020. Did I get that right?
You got it right.
And since then, technology, the way that they created, not the John Roque, but my suspicion is it probably looks similar, on a relative basis made no progress until the last couple of weeks.
And it's still not above its former high, but you're absolutely right. You're right. Exactly right.
And what do you make of that? Do you make that was a well-deserved digestion and now that trend higher can continue? Because when you look at traditional technology, you look at something like the XLK relative to the S&P 500, we're still nowhere near those 2000 highs. Do you think you have room to run, or is the manipulation of that sector by the work that you do suggest that we're closer to those 2000 highs?
We're still above the old highs as tech was constituted in 2000 with me adding everything back. We're still
on an absolute basis.
The relative market cap weight of tech now is not bigger than it was in September of 2020, but certainly bigger than it was in the technology peak of 2000.
In the way you're calculating it.
Correct.
Got it. Well above? How far above?
So back then, the peak was about 33%. So maybe we're 7% above, 6 or 7% above right now. We're still higher.
And is the trend still higher and up and to the right?
The trend is not been damaged. It has been consolidating, as you said, for more than a year. But I think more than that, JC, I put together something that I call the Big Seven. You know them. You know exactly which stocks are in here. The Big Seven are Apple, Amazon, Microsoft, Facebook, Google, NVIDIA, and Tesla. These are the Big Seven. And, they're 40% of NASDAQ. And they're, 20+% of the S&P 500. So we can talk all we want about the market, but if these Big Seven don't come in, the market's not coming down. Just not going to do it. You can't do it. As Steve Shobin told me a long time ago, you only get hurt by the biggest things in the market. You don't get hurt by the smallest things. I mean, if energy goes down here, I'm sure some people will take it on the chin, but the market's not getting hurt. It's less than 3% of the S&P.
If Yogi Berra was a technician, he'd say that it's really hard for stocks to fall when they're going up.
Yeah. In fact, I have a long-time client, so to speak, in the business. You ask him, what will bring the market down? And he'll say to you, the market will go down when it's going down. He created his own yogiism.
What's your favorite yogiism?
It gets early late out there.
Nobody goes to that restaurant anymore. It's always too crowded.
Yeah, exactly. He was wonderful. I met him one time.
Did you?
Yeah, I saw him at Gallagher Steakhouse. He was the guest of honor for a lunch. There was a cartoonist for the Daily News. His name was Bill Gallo. He's since passed. He drew these great sports cartoons. And my father joined what was Bill Gallo's, this is what he called it, Old Geezers Club. I took my father to a few of those lunches, and then I ended up taking my cousin, who's a giant Yankee fan, to meet Yogi. And it was a thrill. I mean, how could it not be a thrill, right?
Did I get this right? Are you umpiring these days? A little side hustle?
It's not. It's just something that I enjoy doing. I wanted to stay involved. I just wanted to stay involved with baseball and softball. So I do a lot of youth league baseball and a lot of youth league softball. And I'll tell you, I really enjoy doing youth league softball. When the game's played well, when the girls play it well, it's really a fast game. It's like pinball because some of them are strong. They can really hit. They can pitch. And if you find a pitcher who throws strikes, the game goes really fast. I did a playoff game in the Bronx this year in Riverdale for boys baseball, and it was perhaps the best game, boys or girls, I had ever done. It lasted 67 minutes for 6 innings, and it was a 2-1 game. And all 3 runs were scored in the first inning. There were no runs after the first inning for the next 5 innings, and both pitchers were just really terrific. All the plays were made. There was maybe one walk in the game, but sometimes you're kind of, you catch lightning in a bottle and you get a beautiful game like that. It's just wonderful to see the kids play so well. Coaches really didn't even have to do much; they just kind of watched it and enjoyed it as well. And when the game's played well and you're umpiring, it's very, very enjoyable.
I'll take a pitcher's duel any day of the week. All the kids, they just want to see home runs. Give me a 2-1 ball game, 1-0. Give me one of those.
If you're an umpire, that's certainly what you're hoping for because the game goes quickly. The alternative is that when the game is played poorly or pitchers can't find the plate, then the game really drags, and that's when I think kids lose interest. I don't know if there's any youth league, administrators there, and I'm sure they would agree, who would be listening, but they should really call the game pitching. They shouldn't even call it baseball because that's how important it is.
Well, you're talking to a pitcher. I was a pitcher for a long time. I was too slow to do anything else, and I didn't hit the ball very far. So they're like, you're a pitcher now. I was like, all right.
So you're going to love this. You might want to read a book. In fact, when we're done, I'll send it to you. It's a book called K, A History of Baseball in 10 Pitches, and it's written by Tyler Kepner. And it's really a wonderful book, and he takes each chapter for a different pitch. So slider, fastball, curveball, nice, knuckleball, splitter, etc. And he goes through the history of the pitch, who was great at it, and commentary around it. And there's so much baseball knowledge in there and just great anecdotes. It was really a terrific book, but I'll send it to you when we're done.
One more baseball question. Do you get heckled more as a market analyst or as an umpire?
As a market analyst. Without a doubt.
That's hilarious. One thing that I definitely wanted to ask you, John, is your lack of interest in many indicators.
Yeah.
A lot of new market participants, people who first hear about technical analysis or think they know what technical analysis is, they think all these sorts of squiggly lines, right? Like one of those hospital monitors with all those lines going across. But I'm certainly not one of those, and you're even more obnoxiously not one of those, right, than I am, right?
I found over time that, and I'm not knocking technical guys because we're both those guys, but I found over time is that too often technical people fall back on the jargon and what the indicator is telling us without really consulting what the most important input is to any particular chart, and that's what the trend is. And you know this as well as I do, and people who will be listening will know it as well as we do, that overbought can get more overbought and oversold can get more oversold. The trick is to know when to ignore the oversold, meaning strong gets stronger, or to ignore the overbought when strong gets stronger, and to ignore the oversold when weak gets weaker. And it reminds me of a book written by a guy named Jesse May, who was a poker player. This was before the advent of Texas Hold'em, and he was a kind of a poker player in the tri-state area. And the book is called Shut Up and Deal. And in the book, he has a great line. He said, when people start to learn to play poker, they want to master the rules. He said, the trick to winning at poker is not to master the rules. The trick is to master the luck. And I think that's true about indicators. You have to know when to use them. I mean, I'll give you an example, and you will know this because you do this all the time. In the early part of the year, the percentage of NASDAQ stocks above their 200-day moving averages peaked at, I think it was about 85% or so. It peaked. It got down to under 40% in September. NASDAQ rose 14% that entire time. So the indicator is important, but not because it was a reflection of what the index would do. It was a reflection of what your exposure should be doing. So the percentage of stocks above the 200-day moving average peaked. It went down about 40 percentage points. NASDAQ went up 14 points, but son of a gun, if you use this indicator properly, not to trade NASDAQ, but to look inside NASDAQ and see which stocks were weakening, you could have made a lot of money on the short side. So that's what I think people who use the indicators or rely on them so deeply tend to miss. They may not be market indicators, they could be exposure indicators. That's how I tend to think of them. I think the indicators help you tell the story, but they're not the story.
Price pays, right?
That's it.
We're just trying to sell things at higher prices than where we buy them, right?
I mean, said Moses, who won the investing championship many years ago and was a Bill O'Neill disciple, said, I want to buy high and sell higher. So to me, it's immaterial where you buy it. It's just, can you sell it as a better price? I think the indicators sometimes help, sometimes don't, but often keep you out. I'll give you kind of a real world example right now that is not indicator focused, but it's more relationship focused. So here goes. Since gold started to trade freely in the 70s, gold has had its biggest upside moves cycle wise as the dollar has been weak. So strong gold usually corresponds with weak dollar. However, in the last week or so, we've seen the dollar DXY accelerate, and we've seen gold pick up and get a little firmer and show a little bit of chutzpah, so to speak. And so there's some talk amongst people that I kind of speak with regularly, how can you like gold if the dollar's going up? And I guess sometimes these relationships don't hold true, in an ensuing cycle as they have in a prior cycle. Never before did we have interest rates at zero during those prior cycles when gold really worked. Never before was there no traders on the floor of stock exchange. Never before was there really QE to this in this regard. So there's a lot of inputs that are not the same. I know historically gold has had its biggest moves when the dollar has been weak, but that shouldn't preclude us from identifying that gold is improving, despite the fact that the dollar is also improving. And if we're waiting for the dollar to weaken, we may miss gold. So I think in this environment of which algos and quant trading is ubiquitous, it's probably better for me to say, I see A, I should trade A. I see B, I should trade B. I should not see A and B and expect to trade C. C may never occur, and it may keep me out of A and B. So that's how I think about it.
And these are lessons that I had to learn the hard way, John. I'm telling you, man, from the bottom of my heart, the overthinking of intermarket analysis that your boy JC has done for so many years is absurd. And I have now, it's like an ongoing joke, like at our firm, like, are we overthinking the intermarket analysis? It's like a joke now. So like we go out of our way to stop ourselves from doing such things. So I got two things for you on that note. Number one, shouldn't we view it, or an interesting perspective on that is how well gold has done despite a stronger dollar? Feather in the hat for gold, in my opinion there.
Yeah, I agree with that. Yeah.
And the other thing is, what about treating gold like a currency, looking at gold, taking the dollar out of the equation, and looking at something like gold priced in yen making new 52-week highs?
Yeah, so I did that the other day, and I sent a note out to our subscribers or our clients entitled, the golden ticket. And I showed gold in 9 currencies. One of them was the dollar, but I showed gold also in, yen, Indian rupee, Canadian dollars, etc. And gold and yen is about 2% from a new all-time high. So gold to me is a currency. Silver is too, and I can look at it like that. To me, it's fine. To me, I could just look at it as, XAU on whatever system you have. It doesn't matter what it is. It could be a metal, it could be a currency, and it's working. And in other currencies outside of the dollar, it's also working, which should make us all feel a little bit better. That it's not just doing it, in US dollars. And of course, because it's always relative to a currency, as you said, because it is, then it's also working across the board, which makes the move more powerful.
All right, so we're talking about gold as a currency. Now let's talk about gold like a commodity, which is what many people call it. I heard a little birdie that you had lunch with recently was telling me that you were discussing gold sort of sniffing out this inflation before the rest of commodities. That was back in 2019. You got that monster move in gold, and when the rest of commodities were catching up over the last year and change, gold was digesting those prior gains. But gold is the leader in that group, not the laggard. Is there some truth to these rumors?
I think that I'm going to speak for commodity guys, although I wouldn't put myself in their camp. I would just say that it is usually that gold is the first firefighter over the wall, your lead dog on your sled with respect to a commodity advance, and it broke out in the summer of 2019, and then it rallied to a new all-time high in 2020. And gold pulled back, like you said, and consolidated, but it opened the door for other commodities. And just to give you an idea, I know you'll know the numbers, but I sent something out to clients today entitled Wall of Voodoo, which was an 80s band, and they had a hit with the song Mexican Radio. And so I said, even stranger than the Wall of Voodoo, Ms. Yellen Coincidence. And please give me a second here, because in the song, Mexican Radio, it has the following lyrics. I dial it in and tune the station. They talk about the US inflation. I understand just a little, no comprende. It's a riddle. Now, I thought that was interesting because when Ms. Yellen was chair of the Federal Reserve from 2014 through 2018, and the CPI year over year averaged a mere 1.5%, she said low inflation was a mystery. It was odd to me that Wall of Voodoo, and there are no PhD economists in that band, and Janet Yellen said the exact same thing. And so I said, inflation's still a mystery at the Fed, but here goes. Even stranger than the Wall of Voodoo, Ms. Yellen coincidence, is the fact that many are now apoplectic about inflation, even though commodity prices have been hinting at higher inflation readings since the Bloomberg Commodity Spot Index broke out of a 6-year base in October 2020. The index is now 45% higher, has kept pace with both the S&P and NASDAQ, and is at new all-time highs. Commodities and not bonds have been the release valve for inflation. So gold was the first one over the wall, kind of sniffed it out, and then it pulled back, resting, which I think its monthly chart is a tremendous Brobdingnagian base that goes back to 2011. You could call it a giant cup and a handle as an homage to Bill O'Neill. But I think it's starting to sniff something out that's a little bit more important here. You know, gold's the lead dog or the first firefighter over the wall. It's coming back to life. And I would tell you that it would probably have been very unlikely that any commodity advance would have extended if gold had not decided to participate again.
So let's say it is that Bill O'Neill cup and handle, big bottom, and this is it. This is that handle. We take out those 2011 highs. What are we projecting here? 5,000, 10,000? How high can we go?
Oh, listen, this is just an estimate. The bottom of the range, roughly, let's call it $1,000 in 2015. And the top of the range, roughly, is 2,000. So the height of that base is 1,000. I mean, you could say it's not crazy to think that you can get to a 3,000 target. Not crazy. We could get to crazier targets, but I don't think it's appropriate to do that. I think 3,000 is kind of, not nuts. That's the height of the base. And if you want to just make it smaller, I mean, so the bottom of the range over the recent range occurred roughly at, let's call it 1670. So let's make it easy on my math and call it 1650. And the high was 2000. So that's, then you could get 2350 would be a near-term target if we could get a breakout above to a new high, which I think we do.
And the fact that we're talking about gold at 3,000, like it's not a big deal, and that's a conservative target, I would agree with that. I think that's fair. That would be a very classic target from a measured move standpoint. So I think that makes perfect sense to me. I'm going to change the subject here for a second. I want to talk about market cap inflation. My entire, career, and you could tell me when this really changed, but small caps have been from 300 million market cap to 2 billion market cap. Then mid caps are 2 to 10 billion market cap. And anything above 10 billion is a large cap. So that's been the case for a long time. And now here we are approaching 2022. We have multi-trillion-dollar companies out there. So there's obviously some sort of market cap inflation out there somewhere. How come the indexes haven't adjusted their market cap, number one? And number two, What we do internally is we just adjusted it. Small caps go to 4 billion and then mid caps go to 30, 35 billion. That's how we look at it. How do you feel about all that?
I think what you're doing is a good way to think about it. I guess probably the growth in the market caps is probably not crazy given what we've seen the growth in the Federal Reserve balance sheet since 2008. It was once $1 trillion in 2008, and now it's almost $9 trillion. And from July of 19 to now, it's gone from just under $4 trillion to over $8 trillion. So it's doubled in a little bit more than 2 years. So I'm sure that has a tremendous impact on your analysis and you doing a rejiggering of those figures. So I think you're on the money.
Because the mid caps are that sweet spot, John. You know what I mean? Like they're big. They've already graduated from small cap status, so they're at least somewhat for real. But they're not big enough where they're these monster large caps. So these mid caps can double. They can double again, then they could double again, and they're still not that big. So there's like that special sweet spot in mid caps, and I think to widen it out towards 30, I think opens us up to finding great opportunities in that particular universe.
I agree with you. I mean, if you and I own a small cap together, we want to see it get to be mid cap. If we own a mid cap, we want to see it be big cap.
Right.
Yeah, I think that's right. And you know it because you've done the work. But when the mid cap index broke out above 1,000, I think it was probably late 2012. 6 years later, the index had doubled. I mean, those are nice numbers.
Those are great numbers. You've been in this business for a while. You've met a lot of really smart people. You've learned a lot of lessons early on. Can you tell me what sort of lessons you've learned more recently in the last few years? Not old lessons reiterated, but more new lessons that you think you find helpful.
I think I've learned over the last several years, the items that seem to make the least sense, common sense wise, tend to have the trends that are the most robust. And I think that's so because people tend to fight them tooth and nail. So if somebody says to you, oh my goodness, if somebody says to me that's going up, it makes no sense. I tend to think that trend could probably stay in force.
Yeah, exactly. Oh, it makes no sense. Perfect. What's the ticker again?
Right. Maybe I should put that on my pad, so to speak, or in my portfolio. So I think that's the case. I think I've learned also that we as market participants try to have a narrative every single day to help us explain market action. Sometimes there's no narrative, number one. Number two is I think also because the business has moved away from being dominated by PMs, actual people PMs, and passive is weightier than active, that we are using human language to sometimes explain machine-driven behavior, and we probably can't do it. And so sometimes it's just better to say, I don't know. I don't have an answer for you, instead of trying to make up some sort of narrative. But the narrative makes people comfortable. So those things really over the last few years. And number three is just knowing in my heart of hearts that the most important price in the world is not the price of the 10-year treasury. It's not the dollar. It's not any, cross for the dollar. It's the S&P 500. And the Fed believes in their heart of hearts that is America's savings account. And there is no way that they want to upset that trend. And so they'll do anything they can to ensure that the S&P is insulated. And I think that's what they get up in the morning to look at. I don't think they get up in the morning to check the euro dollar. I don't think they get up in the morning to check dollar yen, nor gold, nor perhaps maybe they're checking Bitcoin now. But I really believe that the S&P is their benchmark. And when Federal Reserve chairs leave office, they're mark to market on what the S&P did during their tenure.
They're mark to market. That's pretty funny.
Yeah, I think that's the most important price in the world. And nothing bothers anybody in our business until the S&P goes down. If the S&P goes down, then all other potential ills, reveal themselves or reveal themselves as being important or having a negative effect. But until the S&P can no longer shrug off bad news, it's not bad news, because this is the most important price in the world. And it goes up 3 out of 4 years. And I did this study a few weeks ago, which I think you might find interesting. I went back to the 1990s and I asked the question, and Guy Adami made this joke, I don't know, some time ago. Somebody asked him, why is the market up? And he said, because it's open, which is, a cheeky response, but not that crazy. So I went back to the 90s for the S&P and NASDAQ, and I just wrote a formula in Excel. And I said, on average, how many times what was the percentage of the S&P being up throughout the decades of the 90s? So when you turn the lights on in the 90s, the S&P was up on average throughout the entire decade, 54% of the time. In the 2000s, and there was two bear markets then, the S&P was up on average 52% of the time. And then in the 2010s, the S&P was up 55% of the time. Now, over the last 2 years, 2020 and 2021, that number is up to 57%. And I did the same thing for NASDAQ. In the 90s, you turned on the lights, it was up 57% of the time. In the 2000s, the same as the S&P, 52% of the time. In the 2010s, 1 percentage point better than the S&P, was up 56% of the time. But over the last 2 years, NASDAQ's up now 60% of the time. So you turn the lights on and you're up six out of 10 days. And the market's up on average 3 out of 4 years. You could see why it's very important to keep it insulated. To have opposite results would certainly be cataclysmic, and the Fed chair would probably be castigated for his poor performance to not save the S&P, which is why I think they put the hazmat suit on very quickly.
How do you think Edwards and McGee would feel about cryptocurrencies?
I think that they would just kind of chart them out without trying to judge them. I think Paul Jones's line for commodities in the 70s is appropriate to cryptocurrencies now. Paul Jones, who started his career as a cotton trader, I believe in New Orleans, said in the 70s there was not a lot of fundamental information about commodities, and you had to know and pay attention to price and the charts. You had to, because there was really not much else for you to go on. I think the same is true right now for cryptos. I don't follow them, let's say, as closely as some others from a fundamental input as to what's changing or who's adopting it. It seems to me that you could do a pretty decent job using Paul Jones's line and applying it to cryptos right now.
With cryptocurrencies trading 24 hours a day, 7 days a week, and stocks only trading about 31 and a half hours a week. If you annualize it, stocks trade 31 and a half hours a week. Cryptos trade 168 hours a week. So do you have to adjust for that, you think?
My goodness, there are easier ways to get gray hair, JC.
I look at
I think
weekly charts.
About kind of volatility, right? So
yeah,
it trades 5 times as much as stocks. So maybe
right.
You're up for 5 times as much volatility. Is that what you're talking about?
Well, I look at weekly charts to get more structural perspective in the stock market. And then I look at daily charts for more tactical opportunities, right? That's how we approach the stock market. In crypto, it seems like the daily charts are the weeklies and the 4-hour charts are the dailies, right?
That's a good observation. It's pretty ironic, but it's a good one. I don't think that's crazy. I think there's also something to be said. I mean, Bitcoin's been around, I think, for a decade now. And, over its decade, it has had median bear markets. I think they're about 80%. The one that occurred from the spring through the summer was 50% or thereabouts. So I still think the long term is important, but I get your point. I think there's some validity to that. I think you've made a very wry, ironic, yet pointed and important observation. You're going to have more volatility. It trades 5 times as much. So I think you're right. I really do.
What's the best trade on the sheets right now, John?
I don't know if I have a best one, but I really do like Pfizer's long-term chart, and I'm going to use Brobdingnagian base here. So if you go back on Pfizer and you go back, I think it has a 23-year base or a near 23-year base, and the stock is finally or just about getting above where it was in 1999. So I think in terms of big base potential, this is really, really terrific. I think that there are other car companies, not talking about Rivian here, because its market cap makes it the 3rd biggest car company in the world, although I guess it hasn't produced any cars yet. But I think Tesla has been wonderful, but I think it is unfairly takes all of the attention for global autos. And if you look at Toyota TM as an ADR, or you look at the local, which is 7203 space JP, I mean, this is really a terrific long-term chart. It broke out in April of 2021 above where it was in 2015, and then finally again where it was in 2007. So I think Toyota is really, really terrific. I really like the uranium space. I built my own index on the uranium stocks. I think there's some really good potential there. I think the dollar can get stronger. I like gold here. I think there's probably more weakness in tech than the indexes lead us to believe. And I think there's been a lot of big breakdowns there with some stocks that look like they can have some more trouble. So I would encourage people to, if they're looking for stuff to, remove from their sheets because, they're not certain, please look beneath the index level and check the stocks individually because there's some tech stocks that look poor despite the fact that the NASDAQ is unassailable.
There's no question. When you go back to February, I mean, half the NASDAQ lost 20%, right? And over almost 25% of the NASDAQ got cut in half.
Right. And that kind of goes back to that indicator, again, of a percentage of stocks above their 200-day. You had to use it as an exposure indicator, not as an index marker. Right. So I think you are right because those are the numbers. You're right. Just to give you another stock in London, Rolls-Royce looks pretty good to us. Had gotten killed over a period of 6 or 7 years, but looks like it's turned. Fluor is another one, FLR, which trades here, which also got destroyed for a number of years, but looks to us like it's finally put in some measure of a turn. People are looking for things that are not exploited. Those two would be an example. And then if you're looking for stuff that looks terrific and big basey, that's Pfizer. And if not, Toyota, both in dollars and in yen. Those look terrific to us as well.
I'm surprised you're talking about big bases. You're talking about gold and you're not mentioning Newmont.
I've gone through the gold and silver stocks, and Newmont was, I feel kind of like a jilted lover with Newmont because in the spring of 2021, it broke out above $70, which was its high going back to 2011. Newmont really did finally break out there. It did not eclipse, oddly enough, its high going back to 1987, but it certainly got above its high in 2011, but it reversed it fairly quickly. So Newmont is kind of like, you got to show me now because either I disappointed myself or it disappointed me.
Yeah, it already flaked once, right?
Yeah,
so prove you're not a flake.
It's got to show some gumption here or some chutzpah is a polite way to say it for me to get back involved with it. But I got to figure if gold works, it's going to be very difficult for this one not to work.
All right. So what about the stock market overall? Is this the Knicks from the 70s or the Knicks from the 2010s?
I think certainly it has been the Knicks from the 1970s. I know that it's ignored every piece of bad news possible. And again, because the Big Seven represent such a huge chunk of it and they don't go down. It wouldn't surprise me if we had some sort of a corrective phase. I'm not suggesting we'll have one. I'm not forecasting we'll have one. But I mean, even God rested on the seventh day. And so maybe you do get a corrective phase in early 2022. I mean, even to get it back to its upward sloping 200-day moving average, which used to be regular business on an annual basis, it doesn't do it now. And it hasn't touched its 200-day moving average since July of 2020. Now, I don't know if that's historically extended, and actually I do. It has been longer. There have been longer cycles, but it wouldn't surprise me if it did that sometime in 2022 when you had a corrective phase and rebuilt. But the trend's up clearly. It's been monstrous, and I don't think the Fed's going to do anything to change that. In fact, I don't think that they'll raise rates.
So you and I both agree that price is the number one indicator that we're watching to tell us if perhaps we are entering a corrective phase or if the market's going to continue higher. Outside of the price of the S&P 500 and the NASDAQ, what's the one supplement to that you'd point to be like, if that happens, then chances are stocks are under pressure, and if that happens, then chances are stocks are continuing higher? What's the data point you're watching?
I think I'm going to use the 10-year Treasury yield. If it gets above 2%, I think that there'll be an issue because I think people are way too complacent. I think that they believed the Fed's mistake about inflation being transitory. I mean, you know what the year-over-year numbers for commodities look like. You know what you're paying for gas. You know what you're paying for food. I think they've missed it entirely. In fact, inflation is always transitory only because the rate of change always comes in. It doesn't go up, unabated. But there have been prior periods where inflation was, certainly more than transitory. For example, there was a period in the 70s where you printed numbers 6% or more on a monthly basis for nearly 3 straight years. And then there was another period, I'm going to see if I get the note, 1977 through the early 80s, where you printed inflation numbers on a monthly basis, year-over-year numbers on a monthly basis that were greater than 6% for nearly 5 years in a row. And so there have been bigger periods or longer periods. I just don't think anybody has, would go back that far to take a look. So I just counted the numbers. And so we've been at 8 months in a row of greater than 6% year-on-year figures for PPI. You're back to levels you haven't seen since the early 80s. And except for a 12-month period, which peaked in, I think it was 2008, and except for the 59 and 34-month periods and an 11-month period in the early 50s, this is a long stretch. And I'll tell you, of the 4 prior periods where you had bigger stretches, the only one that didn't result in the S&P coming in hard was in the early 50s. Otherwise, in the 70s period and in the early 80s, and then of course in the 2008 period, the S&P came in hard. So I don't know if this is going to be a problem, but I think it's appropriate to use the Michael Crichton line here. You should know your history. That's what the PPI says. And it's surprising to me that 400 plus PhDs at the Fed didn't count the number of months the PPI has been above 6% historically.
Spoken like a true scholar. I make fun of you, John. I got one more for you. I make fun of you because you only talk about sports athletes and rock bands before the 70s, in the 70s and 80s. There was music and sports after the 1980s. I'm not sure if you're aware of that, but
you've been trying to convince me of that for a long time. So I've tried to pick up extend my knowledge on that. So
what do you like watching? What are your favorite athletes today?
So I really like watching baseball. We'll watch a lot of baseball in my house, the Yankees and the Mets. And if there's another game on, we'll watch that. I think Stephen Curry for the Warriors is as good a player as we've seen in a very long time. I watched him last night versus the Nets. He's like Mercury. Every time you think you have cornered him, he slips your grasp and he needs a sliver of a space to get off a shot. He is enjoyable to watch. He's really, really terrific. I like watching him. I like watching Mookie Betts now for the Dodgers. I think he's terrific. I know Altuve had some trouble a few years ago, but I think Altuve is the model for all youth league baseball players. Everybody wants to be Mike Trout, and he's wonderful and fantastic. And he may have been, kind of Mickey Mantle-esque, but I don't think most guys are built like Mike Trout. But I think a lot of youth league guys, a lot of young guys are built like Jose Altuve. And I was Dustin Pedroia before him and Altuve, who told, I would call them little guys, and that's a compliment, that you can hit the ball a long way. You don't have to settle for hitting the ball into the ground and trying to beat out a ground ball to shortstop, which almost never happens. So I think Altuve is really, really terrific, actually underrated. And for a guy his size, hits the ball a ton. So I like watching those guys. Serena Williams is always fantastic to watch just because she's been so dominating. I'll certainly turn on the Rangers. I loved watching Nadal and Djokovic and all those great tennis players who dominated. I think it's like watching or going to a Sinatra concert or watching Picasso paint. When guys like that are on TV or you can go to the arena to watch them, you have to go. Or athletes like that. I mean, Serena would be a perfect example. So I certainly pay attention. It's just that, my analogies tend to go back to a time that I can remember.
You're losing your audience one day at a time. They're all, going away.
I found that people might not understand the references, but Babe Ruth is still important. Theodore Roosevelt is still important. Mozart is still important. Prior cycles in the market are still important.
What about Rogers Hornsby? Is he still important?
He's still important. He only averaged 500 over 4 seasons. So I think it's still important because you have to understand history to be able to look forward. You have to look backward to be able to understand forward. And I think it's, history happens to be my favorite subject. Probably you've gotten that already. Kind of like knowing trivia. What was the captain's name in Captain and Tennille? It was Daryl Dragon. I mean, sometimes that's useful, right? Sometimes that stuff is useful.
Oh, John, man, we got to do this again. We haven't talked since we had lunch, last year, whenever. What was it, early last year?
It was. We had lunch. It was wonderful. Thank you for the offer to be with you. It's a wonderful pleasure for me. Thank you for reaching out. And, you ask and I'll do it again.
Looking forward to it. And we'll get together in the city after the holidays for sure.
It's a deal. Merry Christmas. Happy New Year to you.
You too. All right, John. Thanks.
Be good.
And that's today's episode. Thanks for listening. I hope you enjoyed that as much as I did. Make sure to check out all of our past episodes at allstarcharts.com/podcast.